Hello everyone, welcome to Wall Street Mojo. To know more about this topic, that is the top 20 corporate finance interview questions, watch the video till the end, and if you are new to this channel, then you can subscribe us by clicking the bell icon that's given below. Welcome everyone. Today we have a topic of the top 20 corporate finance interview questions. Let me give you a small snapshot of what we are going to do. We are going to learn as a part 1 the corporate finance basic interview questions. Like, I'll give you some of the brief synopsis, like, what are the financial statements of the company? What do they tell about a company? I would say that second one is like explain what exactly the cash flows goes in details. That can be one of the questions. Explain some of the sources for short-term finance used by the companies, and some of more of the questions like what is working capital, a question like a company buys an assets, walk me through the impact on these financial statements. So these are the couple of things we are going to discuss in the course of our discussion. Let's begin with our first topic, or the first question. See, preparing the financial finance interview, the list contains the top 20 corporate finance interview questions, and those are some of the questions that are the most frequently asked by employees. Well, we will do things in two parts. One is part 1, that is the corporate finance interview questions basics, and then part 2, corporate finance interview questions, which is going to be advanced. Let's begin with the part 1, the corporate finance interview questions, and this will be some of the basics ones. Okay, we'll start with the first one. Now, what are the financial statements of the company? I mean, that is the question. What are the financial statements of the company? And they can also ask that what they tell about. What do they tell about? Okay, this can be a question. So answer to this, how would you answer? See, financial statements of a company are statements in which the company keeps a formal record about the company's position and the performance over time. Now, the objective of this financial statement is to provide financial information about the reporting entity that is useful to existing and the potential investor, or probably the creditors or the lenders, in making decisions about whether to invest or give credit or not. So there are mainly 3 types of financial statements. The first one is what we call as the income statement. Okay, now the income statement tells about the performance of the company over a specific account period. Financial performance is given in terms of revenue and expenses, and the same is generated through operating and non-operating activities. The second one goes as the balance sheet. Okay, now the balance sheet tells about the position of the company at a specific point of time. Okay, third is on the balance sheet only, let's stay there. It consists of assets and liabilities, owner's equity, basic equations of A is equal to L plus O, owner's equity, that's liability plus owner's equity. The third one is the cash flow statement. Okay, now cash flow statement tells about the amount of the cash inflow and outflow, and the cash flow statement tells about how the cash presence in the balance sheet changed from the last to current year. Okay, the second sort of question they can ask is what is the cash flow statement? This kind of a question can also be asked. Well, the cash flow you can divide in, say them, the cash flow is divided into 3: operating, okay, investing activities, and you can say financial activities. Now, if we talk about operating activities, there are cash inflows, like which is generation of funds in the normal operations. Cash outflows are expenditures of the funds in the normal operations. When we talk about investing, the inflows are sale of plant and equipments, liquidation of long-term investments, and outflow can be like purchase of plants and equipments, investments in the long-term investments, and so on and so forth. When we talk about the cash flow from the financial activities, It includes inflows like debt issuance, common stock, preferred stock, and other securities. And the outflow can be something like this, like retirement of debt, common stock and preferred stocks, and payment of the cash dividend. Right. Okay. Let's study the third type. So over here, he can ask the question something like this, that, explain the three sources of short-term finance that is used by the company. The three sources of short-term. See, always remember that, the short-term financing is done by the company to fulfill the current cash needs. And the short-term sources of the finances are required to be repaid within closely around, let's say, 12 months from the financing date. And some of the short-term sources of financing, they are like, the first one is the trade credit. Okay. Now, what is trade credit? Trade credit is basically an agreement between the buyer and the seller of the goods. And in this case, the buyer of the goods purchases the goods on credit. That is, the buyer pays no cash to the seller at the time of buying the goods, and only to pay at a later specific date. So the trade credit is based on a mutual trust between the buyers of the goods and the amount of the cash after a specific date. Then comes the bank overdraft. Okay. Now, this is a type of a short-term credit which is offered to individuals or probably a business entity having a current account which is subject to the bank's regulation. So in this case, an individual or a business entity can withdraw cash more than what it presents in the account, and interest is charged in the amount of the overdraft, which is withdrawn as a credit from the bank. And the last one is, unsecured bank loan. Now, what is this? Well, you need to answer that, that unsecured bank loan is a type of credit which banks are ready to give and is payable within 12 months. So the reason why it is called as unsecured bank loan is that there is no collateral is required by the individual or probably the business entity taking this kind of loans. Okay. Now, quickly, let me run you through the next sort of questions. Something like this, what is the working capital? Okay. Well, you can explain them, the working capital is basically the current assets minus the current liability, and the working capital tells about the amount of the capital that is tied up into the business of the, you can say, the daily activities. Okay. And post factor, you can say that, some of the daily activities like account receivables, payables, inventory in hand, and many more. So working capital can tell us, amount of the cash needed to pay off the company's obligation, which have to be paid off within closely around 12 months of time frame. Now, the fifth question is that, they can ask, let's say a company buys an asset. Okay, so they will ask you that, how about you walk us through the impact on the three financial statement if a company buys an asset? Well, purchase of an asset is a transaction that is done by the company which will impact all the three statements of the company. So let's say the asset is the I'll say equipment closely around, let's say, $5 million. Okay, so in balance sheet, what will happen? You can say that the cash will go down by will go down by $5 million. Okay, and you can say that, that will affect at the same time asset will be recorded. Cash will reduce, equipments will rise by 5 million, which will increase the asset side of the balance sheet and will also increase the liability side at the same time. Hence, the balance sheet of the company, both the places, at one side asset will increase by equipment, other side the cash will reduce. So both asset is increasing and decreasing, and hence the balance sheet of the company will be tallied. In terms of the income statement, if you see, there will be no impact with the first year of the income statement, but after the first year, the company will have to be charged with something that's called as depreciation expense on the purchase equipment, which the company will have to show it in the income statement of the company. And the last one you can say is the CFS, the cash flow statement. Over here you can say the cash flow statement, assuming that only the cash has been paid by the company to purchase the equipment. So the cash flow from investing will result in the cash outflow of closely around $5 million. After this, I wanted to run you through some of the part 2 question. Part 2, which are some of the advanced level question that can also be asked during the course. Now, let us now have a look at advanced corporate interview questions. The first one, then they can ask us is, what is the deferred tax liability and why it may be created or it might be created? That can be a question. So you can say that the deferred tax liability is a form of a tax expense which was not paid to the income tax authorities in the previous years, but it is expected to be paid in the future years. So this is because of the reason that the company pays less taxes to the income tax authorities than what is reported as payable. So for example, if a company uses a straight line method of charging depreciation in its income statement for shareholder, but it uses the double declining method in the statement, so which are reported to the income tax authorities, and therefore the company reports a deferred tax liability as the paid less what was payable. The second sort of question is what is financial modeling? This is something really frequent and they are asking in terms of whenever it comes to the advanced questions. So first of all, you can say that the financial modeling is sort of a quantitative quant analysis which is used to make the decision or the forecast about the project, generally in the asset pricing model, probably corporate finance. And different hypothetical variables are used in the formula to ascertain what future holds for a particular industry or for the particular project. If you say in the corporate finance, financial modeling means forecasting companies, the financial statement balance sheet, CFS, or probably income statement. Okay, and this forecast are in turn used by the company's valuation and financial analysis. And now with respect to investment banking, you can talk about the financial models that you have to be prepared, some of the templates maybe are available on the website itself. The third sort of question that can be asked that what are the most common multiples that is used in valuation? This is one of the very important questions that can be referred to. Well, there are a lot of, I'll just start with, just write EV to sales ratio, EV to one of the most important EBITDA ratio, EV to EBIT ratio, just the EBIT ratio, PEG ratio can also be there, price to cash flow ratio, price to book value ratio, and something like EV to assets ratio. Okay, so something such sort of questions can be asked. Now they can also ask a very important question. The other question can be describe what is WACC and its components. Okay, so you can say the WACC is the weighted average cost of capital which the company is expected to pay off on the capital it has borrowed. It is borrowed from different sources. So WACC is sometimes referred to as the firm's cost of capital. Okay, and the cost of the company for borrowing the capital is dictated by the external sources of the market. The formula is something like this. You multiply the weight of debt into the cost of debt, weight of equity to cost of equity, and so on and so forth. So this was some of the important questions that you should remember while going for the interview, and it will be highly helpful if you take care on these questions. Well, that's the end of the topic. If you have learned and enjoyed watching this video, please like, comment on this video and subscribe to our channel for all the latest updates. I thank you everyone once again for joining this session.